Hello and welcome everybody. This is the latest update from Cullen Wealth on the situation with global investment markets and the economy. My name's Stuart Arnold. I'm Director of Financial Planning, for those who don't know me, and I'm delighted to have with me today our Chairman Richard Cullen and Justin Onakuzi, the Head of Retail Investments at Legal & General Investment Management. And today we're going to spend a short period of time updating you on how Legal & General see the state of the markets. And we've got a couple of questions to ask Justin at the end for today. I think it's important to say it's the 22nd of November today as we record this. We do find ourselves in a situation where global events are moving significantly. And so this is the view at this point in time. And of course, things are changing. I'd also like to clarify that today's content is general. It isn't designed to be advice. If you do need advice on your specific situation, then do please contact your usual Cullen Wealth consultant. Justin is going to give us an update now, so I'm going to hand over to him, share my screen, and he's going to do a brief presentation before our questions and answers. So Justin, over to you.
Thank you, Stuart. The global economy is definitely in a tricky spot. The title of this presentation is Winter is Coming. Uncertainty is rife, driven by three key pillars, which are driving the global economy at the moment, driving asset classes. As Stuart said, my name is Justin Onakuzi. I'm the Head of Retail Investments at Legal & General Investment Management. And I'm going to talk a little bit about navigating these three key pillars and also what asset classes are likely to do in this environment. So on to the first slide, which I'm going to talk to today. You'll see four pillars on here, but the third one isn't really a pillar. So it's a reaction function to the other three. So one, we are seeing these structural inflationary forces. So the likelihood is in the long term, inflation is going to be higher over the next 10 years than it has been over the last 10 years. Really key. On top of that, you're seeing these short-term inflationary catalysts driven by the war in Russia, effectively, where it's pushing up commodity prices, driven by the policy responses that we saw during the COVID crisis, which led to this kind of increased short-term inflation. This is causing central banks to put their foot on the brakes to try and quell that inflation dilemma. That's the reaction function that we're seeing. And the likelihood is that means that growth over the next 12 to 18 months is likely to be lower, likely to see recession in both the UK and Europe and potentially the US as well. But I'm going to talk to you that this isn't all negative. There are some glimmers of light here, in particularly because markets have already started to price in the recession risk. I think that's really important to take into consideration. So let's talk about that first pillar, the structural inflationary forces. A lot of this is driven on the next slide by this that you see here. What this is, it shows globalization. So it shows trade over essentially world growth. So as you see that line going up, trade is getting a higher and higher proportion of global growth. Since 2006, however, this line has gone sideways. Essentially, you haven't seen an increase in globalization. Why is this so important, and why does it impact structural inflation? Because historically, in the late 90s, the early noughties, the developed markets, so the US, the UK, Europe, were bringing in effectively lower cost labor or utilizing lower cost labor in emerging markets. Actually, since 2006, this has stalled. And actually, you can see with, when Trump came into power that he wanted to pull out of NAFTA, for example, a North American trade agreement. We've seen Brexit again in the UK. So actually, these are all signs that world trade isn't increasing anymore and it's going sideways. What this does mean, without that lower cost labour, utilising that lower cost labour going forward, is the likelihood is that the kind of the longer term inflation across the world is likely to be slightly higher than it has been over the last 10 years. On the right hand side, I think you see a very interesting dynamic where it shows the size of the US economy relative to China. And by the next 4 years, we expect China to be, pretty much the same size as the US in terms of total GDP. So no longer be the second largest economy in the world and the joint largest economy in the world. And I do think this leads to a different dynamic in global trade. Really, really interesting. So on to the next slide, which is the kind of short-term inflation drivers. And actually the positive news is here that we're starting to see short-term inflation start to ease. Those supply chains, which was just a problem during the pandemic, where we saw economies opening and demanding goods from countries that were closed, and that caused a huge price spike in some of these goods, such as semiconductors. We're starting to see these supply chains start to ease. That's positive for inflation. We're also starting to see commodities start to soften. So the spike we saw following the war in Eastern Europe, in Ukraine, we're starting to see now that, right across the world, that countries are starting to substitute from Russian gas and oil to other commodities. So you're starting to see that commodity price start to soften as well. And importantly, really, really importantly, we haven't seen inflation expectations rise. So this is effectively where what people are thinking inflation is going to be in the future. Central banks are very keen to ensure that inflation expectations, what people think inflation is going to be in the future, remains around that kind of 2.5% level. And that's exactly what we've seen. We've seen that central banks, that inflation expectations have remained anchored, which shows that people still have confidence in the Bank of England, still have confidence in the Federal Reserve, still have confidence in the European Central Bank. So that, again, is quite positive from an inflation perspective, that those short-term inflation drivers are starting to ease. So actually, the high levels of inflation we're going to see, that we've seen over the past 18 months, look like they've peaked, and we're going to start to see inflation come down. However, the one thing I would add is that we're likely to see a higher level of inflation over the next 10 years than we have over the last 10 years, even if those really elevated high levels of inflation that we've seen over the last 18 months come to an end. On to the next slide and thinking about the central bank, what central banks are going to do. A bit of a complex slide here, but all it shows really is different countries, what the current interest rate is, and what we think they're going to do. And the main takeaway from here is that the market thinks that each of these economies' interest rates are going to peak pretty much in the early stages of next year. Why? Because inflation starts to peak, as I mentioned, but also because growth is going to slow to such an extent that central banks will not be able to hike anymore. So, pretty much end of this year and early next year, 2 more hikes are really priced into markets before central banks have to take their foot off the brakes. You'll see the Bank of England there, and kind of third one down, doing a hike in December, and probably another hike in February before actually easing back in terms of rate hikes overall. So that's the central bank reaction function. What does that mean in terms of recession? So on the next slide, we show recession risks. So actually, this shows defensive. It shows the bond market, and it shows 3-quarter returns. This is really important because actually, if we are heading into a recession, if we are heading into a market which is going to be more choppy for equities, the important thing is what the bonds do. How can bonds provide protection in portfolios? And what this shows since 1991 is the Bloomberg Global Aggregate Index, which shows the global bond market. And what you can see is that in 2022, we've seen the worst 3 months the worst 3 quarters, sorry, that we've ever seen for that global bond market. So you can see the returns have never been this bad for global bonds. The only time we've seen a sell-off to this extent was in 1995. And actually, look at the next 3 quarters though. After 1995, after that we saw the best ever returns for the next 3 quarters for that global bond market. So one of the big questions we always get is, for cautious investors, which typically invest a large allocation to the bond market, what's our thinking of bonds going forward? So firstly, I'd say whenever you see an asset class show its extremes, you tend to get that bounce back that you saw. In 1995, number one. Number two, now bonds do not look expensive relative to other asset classes. And last but not least, if you go into a recessionary environment, bonds typically perform really well relative to other asset classes. Really, really important. And we do think we're heading into this recessionary environment. The UK looks like it's in recession. Europe looks like it is heading into recession. And the US, we think, will follow in 2023. So if you move on to the next slide, I think this one shows the US. So overall, this looks at the top 20 indicators, which we think imply you're going to see recession. So, you can see in the recession in 1990, 2001 and 2008, how many of these indicators were flashing red. We've ordered them in order of importance. And the key message here is that by the end of 2022, we think that 50% of those indicators will be flashing red, but by 2023 we think 70% of those indicators will effectively flash in red. So the US is likely to be in recession by the end of 2023. Now, it's not all negative. It's not all negative because asset classes have actually priced a lot of this negativity in. This is probably the most well telegraphed recession in history. Every single economic commentator that you speak to, the UK press, the US press, it's pretty much out there that we're going to see a recession. So markets have naturally started to price a lot of this risk in, particularly in the equity market. How we think the bond market hasn't yet priced this in, and I think this is where you're going to start to see some really interesting opportunities. So you go on to the next slide. Here we simply show different asset classes across the economic cycle. So early economic cycles, as you come out of recession, mid expansion. So this is where you start to see the middle of the economic cycle, so to speak, where economic growth hits decent highs. Late expansion, so it's towards the end of the economic cycle. Arguably that was the 2021, and you start to see then this early contraction, which I think is the environment that we're in now in 2020 as we come to the end of 2022. And what you can see here is if you focus on the dark blue bar, and so on the far left hand side of each segment, and then the light grey bar on the far right. The dark blue bar is global equities, so shares, companies that we all invest in. Really important because they tend to be the highest returning asset class, but tend to be the most risky. And then you come on to those bonds that I mentioned on the far right, sovereign bonds. Effectively, these are government bonds. So government bonds of the UK, of the US, of Europe. And what you can see is in that late expansion phase, typically where inflation is high, you tend to find bonds actually do quite poorly. But when you get to that early contraction phase, actually what you tend to see is that grey bar starts to be positive. And then as you get deep into a recession, the late contraction phase, that grey bar tends to be higher. We think you're moving into a recessionary environment. So therefore we think it's really important to actually think about bonds again as an asset class to invest in, decent yields, decent valuation, plus we're heading into this recessionary environment. The one thing I would say, you're probably thinking, well, look at the dark blue bar in terms of global equities, negative in early contraction phase. But as I said, this is the most well telegraphed recession in probably history. So I would argue that that's been telegraphed. A lot of that negativity has been telegraphed already. Equity markets have fallen already 60% of what you'd expect to see from a recession. And we do think this is going to be a mild recession, so they may not get up to 100% in terms of the overall falls. And therefore, we do think that that a lot of the bad news has already been priced into equities, and bonds do look quite attractive. So right across portfolios, we've been adding to bond exposure in order to give you that protection when equity markets become more volatile, but also we think they're good value going forward. So as I said, uncertainty does reign. I think it's really important to spread your risk over lots of different asset classes. That's why a multi-asset approach, we believe, is attractive. But we do think in this environment that bonds can be attractive, do show value. So those cautious investors that have had negative returns this year, that actually their portfolios do look more attractive going forward. Thank you.
Thank you very much, Justin. Please stop sharing my screen. Thank you again. I think, Richard, you've got a couple of questions you'd like to ask.
Just following the last slide, Justin, talking about moving into recession now and it hopefully being a reasonably shallow recession. Any thoughts on when we'll start to climb out of recession and what the early signs of that will be?
Yes, so I think that the first signs will be central banks looking to stimulate the economies again. So this is where central banks will start to, well, first of all, pause in terms of rate hikes that we're seeing right across the world and start to think about, okay, when are we going to start to lower rates again? So by the end of 2023, we think we're going to be in a situation where central banks will start to lower rates again, and that should be a positive for the economy. Interestingly, the market typically starts to price in a recovery before the recovery actually happens, so a few months before the recovery happens. So actually, you could start to see equity markets start to turn, or companies' shares start to turn in the middle of next year. But although we think it's going to be shallow, we don't think it's going to be short. But the impacts on the overall economy isn't going to be that large.
Thank you. Just to reflect on something with regard to lower risk investors, we're seeing interest rates go up, and lower risk investors must be questioning now, well, given where interest rates are, is cash a better place for me if I take, say, a 3 to 5 year view? What would you say? I know you talked positively there about bonds and the potential for bonds. Just to go back over that, cash versus bonds. If you take sort of a 3 to 5 year view from here, what would you be saying to an investor?
I think there's a big challenge in holding cash. Inflation, we're talking about, at the moment, we've got double-digit inflation. Okay, we think that inflation has peaked and it's going to come down, but it's likely to remain. It's at such high levels that it's likely to be elevated for the next 12, 18 months. If you invest in cash, you are locking in a loss, right? You're saying that you're happy to receive a loss over time. So I think holding cash at this point in time could be quite a tricky thing. So you're looking at a loss. I think the other thing to note is when you enter recession and you come out of a recession, that's when asset classes tend to be most volatile. When asset classes are most volatile, that's when you can miss out on the big up days. And we know from history, if you miss out on those big up days, for example, since 1987, Charlie, you've seen me show before, since 1987, if you miss out on the 10 top days, the amount you would have accumulated if you put 100,000 in 1987, the amount you would have accumulated if you missed out on those top 10 days is £1 million less than you would if you got those top 10 days. So, having those, being invested on those volatile days, I think is actually really, really important. And you see from the bond market, right? When I showed that bond market slide, in 1995, the second worst loss for bond markets, the next 3 quarters were such big quarters, and that's bonds, and bonds aren't even that volatile, right? So I do think, remaining invested is really, really important, particularly when you get these volatile times.
Thank you. Yeah, a couple of, so in terms of what might go really, really well and provide it as a positive spike, for example, if we were to see some sort of compromise with the war in Ukraine, or China coming out of its COVID lockdown, are there any particularly positive things you would like to see as a fund manager that will give you cause for further optimism?
Yes, so I think the first thing is that volatility always provides opportunity. So when you see kind of big falls in markets and so on and so forth, actually there's opportunities on the horizon. And as a fund manager, what you're looking for are cheap asset classes that you can invest in that are likely to bounce back. I think that's really important. In terms of the global economy, I do think the war, and if the war ended in Ukraine, that would be a massive boost to global risk appetite. So you see risk come back to market, you see cash come back into markets, which I think would be really positive. I do think you touched on the other one, actually, which is the second largest economy in the world. If they tackle this COVID crisis that they're seeing now and can reopen next year, that could be a huge boost to global growth, a huge boost to global growth. The market overall is in this kind of, in a dilemma where they think China must reopen next year, but at the same time they're having this spike in COVID cases that you see at the moment. So it's bouncing from one thing to another at the moment. I think the other thing which could be a positive, we don't think it's going to happen, but there's another thing could happen, is that the US may avoid recession. I didn't really talk about this too much. Our base case is they don't. However, given the amount of savings that you have in that consumers have in the US, actually there is a chance that the US consumer can spend at the time the US actually, as the US economy starts to crack, and they can avoid recession. These consumer makes up, over 70% of the US economy. Consumer spending makes up over 70% of the US economy. So, that is a huge driver. And I would say that is something which I'd call it a positive tail risk in a way, that actually is out there. Don't think it's going to happen, but actually that could be something which is a glimmer of light for the global economy.
And so most of our investors are looking at long-term investment, which tends to mean 5, 10 years, 15 years plus. I guess given that markets are where they are today, much of the uncertainty is being priced into the future, you would still say, taking a 5 to 10 year view, that an equity-based portfolio is likely to deliver well above cash returns over the sort of 5 to 10 year view?
Yeah, I think if you take a long-term view, you expect to get rewarded for the risk you take. And I think it's really important to recognise that there are always risks out there. And we could have sat here a year ago, 5 years ago, 10 years ago. I mean, coming out of the global financial crisis, we've seen kind of almost the strongest returns up until 2020. So the strongest returns for asset classes right across the board that we've pretty much ever seen. At the time in 2009, as we were coming out of the credit crunch, nobody would have thought that we're going to see those types of extraordinary returns. So I think if you take a long-term view, and even a medium-term view, actually you should get rewarded for taking risks. There are anomalies, and 2022 has been an anomaly, but over the longer term, you should get rewarded for taking risk. And therefore, even in the most cautious portfolios, even the most risky portfolios, I would expect over the longer term that the returns you get should be commensurate with the risk you take.
Right. Thank you.
Thank you, Richard. Great questions. Equally great answers, Justin. I'm conscious of time, and so I'm going to wrap up there. I'm going to say thank you very much for everyone for joining us and listening in. It's now a year since we've actually started these client updates. and I think we've learned a lot in that year about what works, what doesn't work. I'm keen though for these to be really useful to you as our clients, so please keep feeding back, good and bad, to either me directly or to your usual Cullen Wealth consultant. I'm keen to hear from you directly on what you want to hear from us. One of the things I am conscious of is getting you in front of other of our fund manager friends. Justin, you'll be pleased to know that you can have a rest next year. Others such as Fidelity, HSBC, Vanguard and Lion Trust are keen to contribute to these, and so that will be coming into 2023. So please do keep feeding back, and thank you again. Goodbye for now.